Good afternoon. This is Tom Aspray with the Viper Report. It's Saturday, February 2nd, and today I'd like to review the market trend analysis for January of 2019. As most of you know, I review my daily advanced decline indicators each day, my weekly indicators each week, and of course, once a month, I review my monthly AD indicators. These are portrayed in this table. The monthly trend looks at all 6 monthly AD lines. They have had a positive signal since March of 2016. That came out of the sharp decline in January and February, where many thought we were going into recession. The weekly trend turned positive on the week of January 11th, about 3 weeks ago. And the daily trend turned positive on January 4th. Let's first look at the NYSE Composite. This is a monthly chart showing a very strong monthly close. The AD line here has moved back above its moving average. It dropped below it in December. That reversed that one. Remember, this is just one of the 6 advanced decline indicators that I follow. Some of you may wonder why this is important. Let's go back to the last bear market. This chart shows you that the monthly AD line topped in the summer of 2007, and at the end of October of 2007, after the S&P and Dow had made their highs early in the year, the monthly AD line formed a negative divergence and then dropped below its moving average prior to the bear market. That high from 2007 was overcome at the end of 2009, confirming a new major uptrend for the stock market. Even more important, in January, the S&P 500 AD line made a new all-time high, moving above the high made in September. This is a bullish indication for the S&P as the AD line is again acting stronger than prices. You can see that it also broke out in March of 2016, giving a strongly positive signal. The combination of the weekly, monthly, and daily AD lines is one of the things I teach students in my mentoring classes. Of course, it's been a great January for the stock market. They had their best year in 30 years. And year to date, there have been some impressive gains, led by the Russell 2000, the IWM, up 11.4%, followed by the transportations, up over 10. Both the QQQ and the SPY show over 8% gains. That's not a bad gain for the year, much less for the month. For the week, the energy sector led the way. Very strong earnings from both ExxonMobil and Chevron helped boost this ETF higher. It was up over 3%. Our Viper ETF position in USO, that's the United States Oil Fund, is showing a nice 6.3% gain in just the last week and a half. Also near the top of the list were the communication services and real estate ETFs, though consumer staples and industrials also showed nice solid gains of over 2% for the week. In a recent video, I discussed how the quarterly pivots help me focus on those ETFs and stocks that I'm looking to recommend in the coming week. And there was one high-yielding sector ETF that's now showing up on the radar. I'll be looking at a specific strategy to get in that ETF in the coming week. If you're interested in my comments during the week, please follow me on Twitter. This is a chart I published on Friday showing you that the high-low analysis, which would have been one of the few indicators that had not turned positive, did so last week as the number of stocks making a new high surged to 132. I've been telling clients we need to get above this 75 level, and finally we did last week. The red indicates the number of new lows. The new lows broke out in early December prior to the market's plunge and have now dropped to very low levels. Well, that's pretty much all I have right now. I'll be getting back to you in the middle of the week. If you want some more information, go to theviperreport.com. And if you're interested in our premium services, you can click on the Viper ETF report if you want specific ETF recommendations twice a week, or the Viper Hot Stocks report if you'd like to have stock picks twice a week and a full market commentary. Hope you have a great weekend. Enjoy the Super Bowl. Thank you.